and bring us into the content here today. We are going to, so if you think about what we do at Tasty, right? What do? We sell out of the money premium, right? Like if you had to summarize what we do to like somebody that didn't know what we did and you only had one line, you're in an elevator, all that type of deal. Like, well, how are you going to do it? Well, we sell out of the money premium when implied volatility is high. That's basically what we do. Well, to shorten that down even more, we sell out of the money premium. Like that is the main thing that we do. Well, are there ever times, is there ever a time when we should take a trade that is, out of the money, that is like currently in an okay spot and actually roll it to an in the money spot? The default answer to that question is always going to be no, right? That's not usually something that we consider. That's not usually something that we do. But today, that is exactly what we're going to do. And I'm going to try to explain why we are going to do it. I know Tom doesn't watch the show on Monday, much like Tuesday, Wednesday, Thursday, Friday. So I think we're in the clear in terms of this coming back on me as an employee of the Tasty Network who's supposed to sell out of the money premium all day and every day. So when to roll a short put in the money. So Ryan, going to bring us into the content today, breaking some rules on a Monday. Man, let's do it. So if we take a look at out of the money, at the money, and in the money. Ryan, you can bring us into the slide here. If you take a look at the differences between out of the money, at the money, and in the money, there's a couple key things that are different between these types of trades in terms of, their metrics and some of the metrics that we look at that I really want to focus on. Typically, we prefer our short options to be out of the money or maybe even at the money, and we rarely consider in the money short options. However, an in the money roll can make sense if you want to lean more directional. If we think about moneyness, delta, and probability, that's what I want to kind of focus on here to kind of make the decision that we are going to make. Out of the money options have a delta that is less than 50. So that simply means that, they have a directional exposure that is, less than 50% of what long stock would feel like or short stock would feel like if you're on the bearish side of things. That's effectively what delta measures. That's one of the ways that you can utilize and interpret delta. It's a share equivalent. Right? Remember, every option contract is 100 shares. So if I have a contract that has a delta of 30, it basically means that it's going to feel like 30 shares out of a possible 100 shares. And then, of course, the delta changes and moves. It's dynamic as the market, moves and changes and floats and bounces and all those things. Okay, out of the money options, delta is less than 50, which is typically what we want because you have, less directional exposure. You're less reliant on directional moves. That's effectively what we're, kind of gunning for when it comes to, delta exposure, directional returns and things like that as out of the money premium sellers. Okay. The probability here is typically the highest of the three that we're looking at. My overachievers have already looked at the green box. When I'm using the terms, these superlatives, highest, lowest, I'm referring to this specific situation. This is not the highest possible probability that you could attain, of course, whereas, in the money is not the lowest possible probability that you could attain in terms of the specific strikes that we might be looking at here in just a minute with our Amazon position. So out of the money, my delta is less than 50. My probability is going to be the highest of these three. Okay. What if I'm at the money? Well, here an at the money option, we know it typically has a delta of around 50. So you're basically going to feel like about 50 shares of stock, pretty much half the size of the full contract notional value. The probability here is still going to be high. When you move in the money, and this is where things get super interesting. When you move in the money, what are you giving up and what are you getting in return, right? Where's the gimme? And where is the gotcha? Well, when I move in the money, if I move from out of the money to in the money, I'm going to be giving up some probability, right? I'm going to be moving from, a high state of probability to a relatively low state of probability, again, within this given circumstance. Okay, that may not sound like a good trade to you, and it really kind of shouldn't sound like a good trade to you, at least at first glance. But what are you getting in return? You're getting more directional exposure. You're getting a stronger directional bias in that stock. Now, hey, I know, man, the market's random. It's unpredictable. Nobody knows anything. In fact, I've heard that before. I don't know who first said that on the Tasty Network, but I think I know the individual that maybe did first say that on the Tasty Network, whoever it might be. Sounds like a good guy. I think I would get along with him pretty well. Nobody knows anything. I know that. I understand that. There are times when you might feel like, I kind of think I know a little something. There might be some times where you're like, man, there's just no way this is not going to work. And so when you're in that situation, which I find myself in quite often, which might explain my negative P&L on the year, you might want to lean a bit more directional, right? You might want to lean a bit more into that bullish bias. You might want to lean a bit more into that bearish bias or whatever it might be. That's a gimme in this situation. Well, here's what's maybe even more fascinating than all of that. When I say the probability is the lowest in this circumstance, in this situation, you might be surprised, you might even be amazed to find it is still oftentimes greater than 50%, even though you are in the money. It's wild, man. It's crazy. It's almost like there's something to this short premium stuff to begin with. So Ryan, go ahead and bring us back in the portfolio. So what I'm talking about here is I'm talking about our Amazon position. This is what I want to focus on. And then also, again, I want to take a look at Google and Capital One Financial. JP Morgan, I mean, we probably should do something with that, but I don't think I'm going to today because I want to spend time on all y'all's questions here on the show. And I want to get to that quickly. So if we look at Amazon, so you can see that we just gotten taken out to the woodshed on Amazon. So I sold this 102 put for Amazon earnings thinking, all right, this thing is never going to be tested. And here we are, 102 put on the brink of being tested. So what are we going to do? Well, we have, we're inside of 21 days to go. So there's only 18 days to go left in the strategy. So we kind of want to roll this guy anyway. But then, of course, because we have the binary event, on the schedule for Wednesday, I kind of want to move this guy out, for that reason alone, just to soften up the Greeks a little bit, just to kind of water down my overall exposure to make any crazy moves on Wednesday a little bit easier to digest. Although I am going to remain bullish through the Federal Reserve announcement. And guys, let's think about this. We're not using fundamental analysis. We're not using technical analysis. We're not even using quantitative analysis. We're not even using probabilistic analysis. I'm using commonsensical analysis. Is there any scenario where the market doesn't rally at least 2% after Jerome Powell speaks? There's just no scenario, right? Bank failures, mark it up. Right? Bank failures, mark it up. Bank failures, mark it up. Those are the three that have happened in the last, 4 weeks, 6 weeks? Every time the market is higher. So why wouldn't the market be higher on Wednesday? So I feel very good about carrying this Amazon bullish position through Uncle Jay on Wednesday. I mean, has Uncle Jay ever let you down before? I don't think so. So we're going to be just fine. So with this Super Bowl, I am going to, this 115, 120 call spread, I'm going to just leave this guy out to pasture. I'm not going to mess with that. I'm not going to touch that. If I wanted to roll that, I have to pay a debit. It's like, hey, I still have 18 days to go. I can just leave that be. There's no additional risk in that part of the strategy. Just leave it be, and let's calendarize our Super Bowl strategy. I want to roll this 102 put out. But here's what's interesting. When I go to roll this guy out, if I go to roll expirations and I go to June, I click on June, and you will see here that I have to go to a 100 or a 105 strike. And right now, Tasty Trade has moved me to the 100 strike. And at first, as I was preparing for the show, I was like, okay, this makes sense. We roll out, we roll down. We roll out, we pick up extrinsic value. We roll down, we give ourselves more room. This is kind of your standard plain vanilla Betty Crocker out of the money strategy, right? This would make a lot of sense. But man, where's the fun in this? Right? Where's the creativity? Where's the innovation? Right? Where's the thinking outside of the box? I was like, I don't know that I want to do this because I kind of have my eye on maybe salvaging a part of that long call spread that we're going to leave out to pasture without having to do anything with that long call spread. And here's what I mean. Rather than rolling to the 100 strike, I was like, what if I roll to the 105 strike? Again, nothing crazy. We're just talking out loud here, right? We're not signing on the dotted line. This is very much just an unofficial fireside chat. Let's just see what it looks like. If I roll to this 105 strike, take a look at where I'm at. I would be rolling to an in the money strike, right? Because Amazon's at 102.50. I'd have the 105 strike. So this price down here, you can see this, almost $3. This has what? $2.50 worth of intrinsic value. So the reason why the credit is so much greater than it was at the 100 strike is because I'm rolling to something that's already, it's already sitting on some amount of intrinsic value. The difference between the current price of Amazon and the strike price that I would have, so 102.50 and 105, that's about $2.50. That's intrinsic value that's in that option. Well, if Amazon does rally, and I don't need a crazy rally, I need like a bid-ask bounce. right? I don't need very much. I need a couple of points, right? If Amazon rallies above 105, then obviously the option will be fully out of the money. The option will be fully out of the money, and it will be on a pathway forward to an overall price, to an ending price of 0, where there's no intrinsic value. And so it's like, man, I kind of like this situation. I kind of like this situation because I'm a little bit more bullish. Again, I effectively have to choose between 100 and 105 anyway. They don't have the 102 strike available for me in this cycle. So I'm really, having to choose between going further out of the money or maybe going in the money. And I thought, hey, just to mix it up a little bit, just shock the muscle a little bit and just play the bullish bias going into Uncle Jay on Wednesday, because the market never goes down. So we're going to be perfectly fine. We sell this 105 put, and this could really, really work out well if the market does rally. And you can also see I'm really not margined any more than I already am on the position. So there really isn't much of a difference. So let me make this roll really quick. And then I want to show you guys one final thing about this strategy. It'll be a little bit easier for me to show it to you after I do the roll and just kind of look at it more cleanly in the option chain. So let me go down to like 298 just to do it, just to be done with it. All right, so fill for 298. So boom, we're out at 298 or in at 298 or over at 298, whatever it might be. So take a look at, so let's say I didn't even have this trade on, because I think this is just a little bit cleaner. Let's say I didn't even have this trade on and I was looking at Amazon. And I was like, hey, I want to sell this in the money put. I want to sell the in the money put because you can see the delta here is 57, right? So it's a little bit stronger of a bullish bias than I would have at the 100 strike. You can see the 100 strike only has a delta of 39. So we're not talking about a huge difference. Like, we're not talking about a major difference. We're talking about a tiny difference. If I sell the 105 put, check this out. If I sell the 105 put, which this is basically the trade that I have on now. I know it's a little bit complicated and a little bit convoluted because I still have that call spread out there. So that's kind of why I want to start over with a blank slate. Look at my probability, guys. Look at the pop on this trade. It's still greater than 50%, right? The P50, 72%, right? So even though I'm in the money, even though this thing has a couple of points of intrinsic value, I still have a high probability situation on my hands. Now, is it as high a probability as I would have if I stayed at the 100 strike? No, it's not. And that's the difference between out of the money premium and in the money premium. But I like this trade because, again, given the big move in Amazon from earnings, I like kind of taking the contrarian roll here and playing this thing to the upside. And so that's why I'm doing it, rolling to the 105 strike, rolling to an in the money put. How you like me now? So let's take